If you've followed the market at all, you know the story around Robinhood markets, ticker Hood. For years, the whole narrative was just high drama.
Oh, absolutely. Meme stock volatility, retail traders.
And crucially, this idea that it was a massive, continuous, cash-burning startup. It was sort of the poster child for a fintech that was just constantly fighting to stay afloat.
That narrative got incredibly sticky. I mean, for the longest time, the only real question was if they could ever turn a real consistent profit. The market had kind of already made up its mind.
Exactly. But the analysis we're diving into today, it paints a completely different picture. It argues that the old story, that cash-burning startup, is officially dead.
Right.
We're looking at this incredible pivot from that position to, well, a staggering $556 million in net profit. That's a huge swing.
It forces a complete reevaluation, doesn't it? The analysis we're looking at is taking an extremely aggressive, very contrarian buy stance.
Okay.
The core idea is simple. The fundamentals have totally changed, but the market's perception, it just hasn't caught up yet.
So our mission today is to unpack that shift for you. We need to get into the mechanics of how the financials flip so hard, where this new revenue is coming from, and maybe most importantly, why its recent inclusion in the S&P 500 is being called the ultimate game changer.
An S&P 500 profit machine, that's the term they use.
Yeah. So, okay, let's start where the bears used to have all the power. The balance sheet.
The first pillar of that old bear argument was simple. Robinhood loses money, period. So we have to tackle that head on.
And the analysis says that's just not true anymore.
It says that premise is totally invalid now, and it points directly to that $556 million net profit figure.
What's interesting to me, though, is that it's not just a sign that they stopped losing money by, cutting costs everywhere. A lot of times when a growth company finally hits profitability, it's because they slammed the brakes on everything.
And that is the crucial distinction here. That's what really validates the whole thesis of this analysis. They didn't just trim costs. The source material highlights that revenue has actually doubled year over year.
Doubled.
Okay. Yeah. So that suggests the profit is being driven by explosive top-line growth. It's a healthy, accelerating business, not one that just, managed to squeak into the black.
So if revenue doubled, where did all that new growth come from? It can't have just been from their existing equity trading, which is mostly free.
It wasn't. The analysis points directly at the success of their new verticals, crypto trading, futures, and these new prediction markets.
Ah, okay.
That's where the momentum is coming from, and they're all significantly higher margin than just basic retail stock trading.
Let's dig into that margin argument, because that seems to be the core strength the analysis is pointing to. Why are crypto and futures so much more profitable for a platform like Robinhood?
Well, think about the complexity and the order flow. In these more specialized areas like options on futures or crypto staking services, the spread and the ways they can monetize that flow are just much, much wider.
Some more room for them to make money on each transaction.
A lot more. And when you have tens of millions of users, and even a small piece of their activity moves into these higher fee products, the total revenue gain is just enormous.
So the platform is built to handle huge volume cheaply, and now that volume is shifting into their most lucrative product.
Exactly. And that leads us straight to this concept the analysis calls hyperscale. We should probably define that for the listener.
Yeah, let's do that.
Hyperscale basically means they've hit a point where adding another million users or processing another $1 billion in trades costs the company almost nothing extra. The infrastructure is already there.
So every new dollar of revenue becomes incredibly valuable.
It does. And when you get that kind of operational leverage, that hyperscale, you see these truly staggering profit margins. The analysis cites the net profit margin as being over 50%.
50%? That's massive for any company, let alone one that people were mocking for burning cash a couple of years ago.
It completely shifts the conversation. The analysis even compares this margin to legacy banks. The big incumbents with physical branches, old tech, huge headcounts. They can't touch 50% net profit margin.
Right.
So the claim is that Robinhood is now, percentage-wise, more profitable than many of them. It's a highly efficient financial engine now.
So to put a finer point on it, they've gone from needing venture capital to funding their own growth. The engine is tuned and running hot.
The financials are the engine. Now, we should move on to what the analysis calls the rocket fuel.
Which is that big external event, Robinhood's addition to the S&P 500 index. This is what supposedly transforms it into the S&P 500 beast.
This is so critical because it moves the focus from their internal profits to external market mechanics that basically guarantee future demand for the stock. This isn't symbolic, it's a mechanical process.
Okay, so for our listener who isn't tracking index funds every day, break that down. Why is getting into the S&P 500 such a huge structural event?
Think of it like this. It's like winning a massive mandatory government contract. The buyers, trillions of dollars in passive ETFs and mutual funds that track the index, they must now buy Hood stocks.
They don't have a choice.
They have zero choice. Their job is to mirror the index. So a fund manager can't say, oh, I think Hood is too expensive, or I don't like its history. If Hood is in the index, they are obligated to buy it. The analysis calls this forced buying.
And the scale of that is just staggering, right? We're talking trillions under management.
Trillions. The sheer volume of mandatory buying needed to track the index creates this massive continuous institutional bid that it didn't exist before they were included.
The analysis says this creates a permanent floor under the stock price, but
Yeah.
I mean, isn't that a pretty strong assumption? Permanent is a long time.
That's a great point, a necessary point of friction.
What happens if they were ever removed from the index? That permanent floor becomes a trapdoor, doesn't it?
It does, and the analysis kind of focuses on the immediate structural impact. Removal is always a possibility way down the line, but for now, the mandatory demand is the entire story. It argues that this structural demand is what makes that one $10 price defense we'll talk about so much more powerful.
Okay. And the seal of approval, it radically changes how institutions see the stock. It's not that risky retail bet anymore.
Precisely. It's the ultimate validation. The analysis literally categorizes Hood as a blue-chip financial technology stock now. And that shift has immediate direct consequences for analyst price targets.
We're already seeing those targets move, right?
Massively. They're being re-rated from around $90, which reflected all that old skepticism, to new estimates of $150 and above.
And the reason is the index inclusion.
It's explicitly the reason. The report says institutional funds must get exposure, so analysts are just updating their models to account for that multi-trillion-dollar tailwind. That's the beast mode they talk about. Structurally mandated demand just driving valuations higher.
Okay, so we've got the financial transformation and the structural tailwind from the index. That's the fundamental case. Now let's look at the immediate price action, because the analysis says it confirms this institutional money is already flowing in.
Absolutely. I mean, if you accept the thesis, you need to see the proof on the charts. The stock closed recently at 115.21, up almost 2% on the day.
But the report really zooms in on the intraday volatility, calling a specific dip a classic bear trap. Walk us through the psychology there.
It's a fascinating bit of price action and a perfect example of how smart money supposedly operates. So the stock opened a bit higher, around 115.48.
Okay, so some early enthusiasm.
Right. But then, moments later, there was this sharp, quick sell-off. A flush down, they call it, that dropped the price all the way to 110.41.
A drop like that would trigger a lot of stop losses for retail traders, right?
That's the whole point of a bear trap. It's designed to shake out the weak hands. But crucially, the analysis notes the stock didn't stay down at 110. It ripped back up almost immediately and closed near the high for the day.
So the interpretation is that big institutions, the smart money, stepped in right at 110 and just bought everything that was being sold.
That's the translation, yeah. They defended that price level decisively, absorbing all that forced selling and confirming a strong confidence floor.
And the buying didn't even stop when the market closed.
No. The after-hours data they cited showed the momentum kept going, pushing the price up to 115.78. So institutions were still accumulating shares even after hours.
So what does this translate to in terms of actionable technical levels for the learner? If 110 was just defended so hard, is that the new critical support?
It is. $110 is identified as the new line in the sand. A break below that would, invalidate the immediate bullish setup.
And looking up, what's the target?
The analysis immediately targets at the 52-week high of $153.86. It notes that even at 115, the stock is still about 25% below that high. So significant upside.
Let's talk about the elephant in the room that might make a traditional investor nervous. The valuation. A price-to-earnings ratio of 48? That is not cheap.
That is a legitimate concern, and the analysis deals with it by framing that PE in the context of growth and this unique structural demand.
How do they justify 48 times earnings?
They deem it reasonable for a company doubling revenue year over year. But you're right, that requires some faith.
It requires faith in that growth continuing and, more importantly, in that S&P 500 tailwind being strong enough to support it.
That's the argument. The report says the structural demand from index funds fundamentally changes what a reasonable valuation is. When you have guaranteed buyers, the market is willing to pay a premium.
So the growth justifies the PE, and the S&P inclusion guarantees the demand that supports that premium PE.
Precisely. And so the report concludes that with the profit, the S&P tailwinds, and that strong technical defense at 110, the path of least resistance is UP.
And the strategy is pretty simple.
Very simple. Buy the dip around the 110 to 115 range.
Okay, so that brings us to the synthesis. This report is painting a picture of a total transformation from a struggling startup to a powerhouse ready for institutionally mandated growth.
We hit the 3 core pillars. First, that massive profitability, the $500 million profit driven by crypto and futures.
Right.
Second, the structural support from the S&P 500 inclusion, which forces trillions of dollars of capital into the stock.
And third, the recent price action, that bear trap, confirming that institutions are already accumulating and defending that key $110 level.
Which leads to the overall verdict from the analysis,
Yeah.
an unambiguous strong buy. The report really urges people not to let the volatility scare them away because the fundamentals, they claim, have never been better.
And that leads us to our final provocative thought for you to consider. The whole valuation argument really hinges on this idea that mandatory institutional buying, that S&P 500 tailwind, is enough to justify a 48 PE and targets above 150.
We know that seal of approval and the forced buying add huge value at the start. But the question is, at what point do those structural tailwinds? When do they become fully priced into the stock? Is that tailwind a continuous driver, or is it more of a one-time reset of the valuation?
Exactly. When does the technical need for funds to buy the stock just go back to being a pure fundamental valuation based on earnings? That's the point for you to mull over and explore further.
A fascinating dilemma for the modern investor.
Thank you for joining us for the